Hey guys, my name is Forrest. I invest in stuff. Today we're going to talk about some of the things happening in the world right now and how those are affecting housing prices. I'm gonna grab this cup of coffee and meet you at my desk. Let's get it. JK, I'm still actually getting my coffee. Here it is. With the F mug. By the way, it would help me out a ton if you hit the like button, subscribe to my channel, hit the notification bell as I share my ideas with you to help you become the best investing version of yourself. Should you buy a house right now? And I'm actually not going to tell you the answer right now. You're going to have to wait till the end of the video. I'm just kidding. It depends is the answer. It really, really depends. I think that if you're buying a home to live in, right, that means that you find a place and you really love it, and you want to start a family or whatever your reason is for buying a house. I guess it doesn't have to be starting a family. That's okay to buy a house, but understand that just because we've had runaway housing home prices, I know people that have bought properties for $100,000 back in December, and now that property could be worth $115,000 just a few months later, and that's 15% appreciation in just a few months. Sounds awesome. It sounds like everybody should be buying houses, right? But really what that looks like to me as an investor is inflation. So I'm sure you've heard a lot about inflation in the markets. We're going to talk about what all these things mean. If you're someone who's possibly a first-time home buyer, though, this video is really geared towards you. So stay tuned and let's jump right into it. There's really two things that you need to know as a new home buyer right now. One, home prices are at historic highs. People have been saying that the market is going to crash for ages now, and now you're probably thinking, Forrest, that's just because real estate is the best investment ever. And yeah, you're totally right. It absolutely is one of the best investments that you can make. It's a tangible asset. I love it, but the housing market is cyclical. At least it should be. And so when I look at our most recent bull run in the market and think about opportunities for new buyers to come in, for the overall economy of housing to even out, and for money to change hands, we're in a really weird predicament right now. People have also been saying that the housing market is going to crash, last year, the year before, 2020, 2019, 2018, right? And we continue to see these crazy prices, but I do think today is unique for a few different reasons. One, interest rates, right? So if you've been following the news, right, and we're going to get a little bit complicated here, but if you're following the news, you've probably been hearing maybe some discussion about the interest rates being raised, right? And this is the real interest rate. The interest rates that they're talking about is basically the cost for banks to borrow money. And we'll talk about what that means, for us as individuals. The other thing is the war going on between Russia and Ukraine. And so we won't talk too much about politics or anything like that. But really, we're in a global phenomenon right now that is heavily impacting the market. So for those of you who are new here, I trade very often. I actually need to shoot some more videos talking about my day trading. That's actually why my channel has been inactive. I've just been heads down trading like every single day. And I wanted to do content on it, but honestly, there's been so much stuff that I've just been learning. But yeah, I'll shoot some more videos on that. But back to this. So there's a war going on. It's messing up, exports. Companies are taking hits. People are tightening up their purses. There's a lot of things at play, right? So let's talk about interest rates. And we're going to do this visually. So I've got this handy dandy prop money, which I've always had. If you ever see money on the internet, by the way, it's definitely fake. But I've got this handy dandy prop money. And let's just say that, this is $100. I have $100, right? I'm looking to buy a house. I have $100. Now, I can go to the bank and I can buy money to buy a house, right? We typically would call this getting a mortgage or getting a loan, right? But really, I'm buying money to buy the house. You're not buying the house outright. The bank is buying the house and you're buying money from the bank. And let's just say in our example scenario that I can buy with my $100, I can buy $500. So now I have 100, 200, 300, 400, 500. I have $500 that I can buy from the bank. The bank is willing to sell me $500. That means when I go out to the marketplace and I'm looking at homes, myself and everyone else who originally had $100 We can all afford to buy $500, sorry. And so I'm going to be looking at houses, and what that's going to do is for everyone in my income level, prices are going to, let's just say, be magnetic towards $500, right? And let's just say I'm middle class. And so all the homes that middle class people buy are now going to be $500 or around that $500 mark, because that's the most that we can buy. You know, some people are smart and they're like, okay, I can buy $500 worth of money, but I'm only going to offer up to $400 because I don't want to extend myself. Right? That's an example of buying money. We won't ignore what the rate is or even talk about the actual numbers. So let's say that money gets cheaper in the second scenario, right? And the second scenario is basically what has happened to interest rates over the last, 9-10 years, right? Interest rates got to historic lows. So I have $100 again in this second scenario. But now when I go to the bank, they're like, you know what? Money is pretty cheap. We're gonna make it pretty cheap. And instead of selling you $500 for $100, we're gonna sell you, let's just say, $1,000. We're gonna sell you $1,000. So they give us a ton of money now. I buy my $1,000 with my $100, and I go out into the market. So now me and all my peers, we all have $100. We all go to the bank. The bank is willing to sell all of us $1,000 for our $100. And homes now are going to be magnetized around that price. Why? Because there's competition, right? Buyers, somebody offers $600. Well, we can all borrow $1,000, which means somebody else can offer $650, which means someone else can offer $720, which means someone else can offer $825, which means someone else can offer $970. Then someone comes in at $990, and then ultimately someone comes into $1,000. And that is the relationship between interest rates and home prices. Now, you're probably saying, Forrest, is it really that sticky? Is it a one-to-one relationship? No, it's not at all. As you see, really what interest rates do is it allows people to borrow more money. And when people have more money, that forces the prices of things up whenever you're doing leveraged buying. That's what we call it. We're using leverage. We're buying money. We're borrowing money in order to do asset purchases, whether it's real estate or even other things in life. So keep that idea in your mind. Right? As interest rates go down, the things that you can buy with borrowed money, the value or the price of them in the marketplace tends to go up. Now, maybe you see where I'm going with this, right? That's historically, interest rates are now going back up. And what do you think happens when interest rates go back up, right? The inverse is true. So now when I go to the bank, I have my $100 and they're saying, you know what? We used to sell you $1,000 for $100, but now we're only going to sell you, $700. And there's a ton of ramifications for this. Let's go through them in order. The first, let's just talk about, the availability of money. So in our third scenario, which is after our second scenario chronologically, right? We'll say that myself and all my peers, we can borrow up to $700. And we're trying to buy houses from people who bought them in an environment where banks were willing to lend them $1,000. So now we have a really interesting situation where these people who were buying in the last cycle and kind of expected interest rates to stay low or keep getting even lower, now we're trying to sell to people who don't have access to as much leverage, right? It literally cost the new buyers more money to buy assets. And so there's two things that can happen, right? And it'll take a little bit of time for these things to play out. They can lower their prices, which will happen, right? So they'll start to lower their prices to meet the current demand. But what can also happen, which will just really, it's the same thing, is that as people start to see that it's harder to exit, with a large amount of appreciation, all of the people who bought with, maybe over leveraged, right? All the people who spent as much money as they could borrow, the people who spent $1,000 now need to sell, right? Because they see, oh, shit, so-and-so down the street, their house didn't sell for as much as it's supposed to appraise for. I got to sell mine now. So now everybody is racing to sell their house so that they can make as much as possible before the prices crash. This causes what should be the end of a bull cycle in the housing market. And again, I'm oversimplifying the heck out of this for the sake of example. I know a lot of the points that people are probably going to try and rip me apart for in the comments. I get it. I buy and invest in real estate. Simply trying to describe some of the nuance, or really the relationship between interest rates, home prices, and what that means for you as a potential first-time buyer. So if you're a first-time buyer, or someone who's really trying to buy in general, understand that rising interest rates should put downward pressure on real estate prices. And I'll say that again. Rising interest rates should put downward pressure on real estate prices across all categories. What happens if interest rates rise and housing prices, holy crap, it's hard to speak, don't start to fall immediately? That's a very, very bad situation. And obviously this isn't a one-to-one relationship, right? It's not something that is necessarily going to happen immediately. But if we see this divergence between interest rates and home prices, that's really bad for new buyers. It's really bad for millennials, people, in my generation. It's really bad for Gen Z buyers who are trying to buy houses as well, because we're literally in a situation where we have all these people who got homes by buying money very cheap, and they're basically saying, F you, new generation, we're going to charge you more to borrow money. The market isn't going to adjust, and you're stuck in this situation of perpetual renting, which is an outcome that is possible. Now, why would this happen, or why could this happen? There's a lot of, I think, changes in the flows of money. But one of the biggest changes that we're seeing now is that people are willing to, one, not build new housing, which creates a natural appreciation on home prices, housing prices, and in general, there's this expectation, almost this cultural expectation, that the prices of homes going down is bad due to the last recession that we had, and I think that's really bad. Prices should go down. Going down is not bad, right? If you bought something for $100,000 and it's only worth $90,000, you'll take a loss on that sale. But guess what? That's the way the economy is supposed to work. That's the way that a marketplace should work. And if you go to anybody, and I think this is the real problem that I want to get at in this video, is everyone seems to think that if numbers go down, bad, but that's not the way that it is. It should totally be okay for people who are playing the game in the marketplace to take L's. It sucks when people are underwater and things like that, but that's why we all have to be educated and do our own due diligence. And again, understand that we should not, just because we have $100 and can buy $1,000 with $100, necessarily borrow all that money, buy all that money, and go and over leverage ourselves, especially if that house we bought for $1,000 goes down and is only worth $700. So here are the big takeaways from this video. One, do not over leverage yourself. Wait it out. If you're a first time home buyer, especially, be really, really in tune with your market. Look at the prices in your market, especially. Different types of real estate appreciate differently as well. Take the time to learn that. Buying a home is one of the biggest purchases you will make. There's nothing wrong with this head down, learning all this stuff. You make a purchase and you can forget it until you have to sell your home in 5 or 10 years. The second thing is that if you own real estate and you're looking to sell now, understand that if you refinance, interest rates are already rising. Mortgage companies are trying to preempt some of this change. My buddy's a broker. He's quoting people 2 points higher than he was a few months ago. Right? So if you got a loan for 4%, now you're up at 6%. That's a big change, on a 30-year fixed mortgage or even a 15-year, whatever it is. Any loan product, that's a huge change. So be aware of that. Understand that prices, due to this relationship, you're probably going to have less buying competition. Demand is going to go down, which means when demand goes down, supply goes up, especially as more sellers into the market. Prices are going to go down. So might be time to sell, but then you're back in that race condition situation. So in any case, that is it. Should you buy a house? There's always a good deal out there. I mean, I'm still looking for deals, still looking to buy more real estate. Always am. Just wanted to get these thoughts out there though. By the way, it would help me out a ton if you hit the like button, subscribe to my channel, hit the notification bell, as I share my ideas with you to help you become the best investing version of yourself.